Welcome to the Custodian REIT investor update call. We're just waiting a few seconds for the system to admit all the participants. I'd just like to run through a few admin points. If at any point you have issues or drop off, please email distribution@frostrow.com and the team will assist you as best they can. We will distribute the presentation slides after this call, and there will also be a recording available. The format of the call will be a presentation from Richard Shepherd-Cross and Ed Moore, the portfolio management team of Custodian REIT. This will then be followed by a question and answer session. At the bottom of the screen, you should see three icons: chat, raise hand, and Q&A. Please use the Q&A button to submit your written questions at any time, and these will be answered after the presentation. If we cannot get round to answering them, or you have further questions, again, please feel free to follow up at distribution@frostrow.com. There's been a very interesting time in the markets of late, not least since inflation reared its head in earnest. Central banks made a move on interest rates, and Vladimir Putin started phase 2 on Project Ukraine. Custodian REIT, being focused on regional, smaller commercial properties, has been very active in identifying higher yielding commercial properties, diversified by subsector, investing industrial, office, retail, and alternatives. This activity in buying up properties in specialist smaller properties has played out well in the trust returns in both NAV, uplift, and income generation. I will now hand over to Richard and Ed to speak in detail about the trust positioning, performance, and outlook for the future.
Thank you, Matthew. Good morning, everyone. I'm Richard Shepherd-Cross. You will see Ed Moore on your screens as well. He's going to speak to you with me as we go through over the next 30 to 40 minutes the slides in front of you. So Custodian REIT, we feel that for perhaps too long we have hidden our light under a bushel and have identified ourselves merely as a generalist, diversified property investor. But the more we have thought about that, the more we believe that we are genuine specialists in the field of regional, smaller properties. And as we go through these slides, I hope to be able to explain to you why I believe that's true and why that should be of any interest to you as investors. I'm the fund manager, investment manager. I've been working in commercial property for over 25 years and have launched and have been running Custodian REIT since 2014. And Ed Moore is finance director, again, who has been with the fund since IPO. We've got a full team that manage all the properties in-house. So we've got 6 chartered surveyors and 2 trainees, and a strong finance function. Really important in that we collect all our own rent and manage the properties ourselves. 2 things that we think are absolutely essential ingredients of running a real estate investment trust. Ed's going to take you through the recent financial headlines.
Thanks, Richard. Morning, everybody. So I'll kick off with headline performance for 12 months to December 21. Firstly, dividends, and Custodian operates as a true REIT. So seeking to distribute the vast majority of our net rental income. As rental levels and rent collection rates have stabilised since the onset of COVID, with around 93% of contractual rent collected in 2021, we steadily increased our dividend, having cut it back in early 2020. And that includes a 10% increase for the current quarter to give a prospective dividend of 5.5 pence and a yield of 5.2%. We've seen 12-month NAV total return of 23.7%, which comprises 5.7% of dividends paid and an 18% capital return. And that includes some profitable opportunistic disposals as well as general valuation increases. And Richard will talk a bit more about sector performance later. I'm sure you'll glean from this presentation that although we have a strong focus on asset management, that we aren't scared of selling assets when the right offer is received, and that appreciation, capital appreciation, is welcomed by shareholders. It's the income element of total return that we really seek to maximise, because that's the bit that will reliably deliver for shareholders every quarter. We have a vacancy rate of 9.1%, but importantly, 30% of that vacant space under offer, and that's across all sectors, including retail, and with 35% under refurbishment. And I'll give some examples a bit later on of the positive impact those refurbishments have on valuations and our environmental credentials. Net gearing is at 19.5%, so somewhat below our 25% target, as we continue to redeploy around £50 million of sale proceeds from opportunistic disposals last autumn, the lion's share of which was a portfolio of slightly secondary industrial, which commanded a significant premium to valuation, but that in a more normal market might have been quite difficult to relet. But most importantly on this slide is that dividends remain fully covered, and having dividends fully covered by earnings is really sacrosanct to this fund. You'll see on the slide we had an earnings cover of 105% for the 12 months to December 21, and perhaps that doesn't seem like a huge amount of headroom, but we've demonstrated recently that where earnings capacity exists, we'll seek to increase the level of quarterly dividends, or even pay special dividends as we did last June, to operate as a true REIT and try and maximise shareholder returns. And I'll hand back to Richard.
Thanks, Ed. Investment strategy for Custodian REIT. And this is when we're really going to dig into the regional smaller property strategy. And headlines to our strategy is that we are looking for properties broadly of less than £10 million. Why? Because that is where there is space in the market that is above the reach of a lot of private investors, often who have deep pockets for the right assets, but below the interest of most institutional investors. And this is where we find that there is an opportunity to acquire properties with a reasonable margin versus buying larger lots in the same sectors. We particularly want properties with high residual values. What do I mean by that? We want the value of our property to be in the real estate, in the bricks and mortar, and not so much in the leases. Leases depreciate over time, and time seems to go awfully quickly. But the underlying value of the bricks and mortar, that residual value, the vacant possession value, is a very keen focus for us when we're acquiring new properties. And of course, by having those properties with higher residual values, we get less volatility in valuations over time, which is all to the good for shareholders. We focus not on London and the Southeast, which is the hunting ground for so many investment managers, but in regional regions across the UK where there are strong local economies. And everyone listening to this will know different parts of the country, and will know that in every part of the country there are micro markets where there is that particular strength. And of course, all that leads to reduced vacancy. And vacancy is one of the biggest costs of property investment. If those properties are not producing an income, they're probably actually costing you money in empty rates and letting fees and refurbishment costs. So keeping those properties occupied, minimizing vacancy, is very important. We can achieve that by getting the properties in the right micro locations, albeit spread across the UK. And areas where there's an imbalance between supply and demand. Probably an obvious statement to make, but it is that imbalance that drives rental growth. And as we enter into a period of inflation in the economy, it's rental growth that is going to see us right and give us that income, real terms income protection as we move through this inflationary environment. We want modern buildings, or those that would be considered fit for purpose by tenants, and that is increasingly a focus, particularly as the ESG agenda really gathers momentum. Clearly, this is something we should all have been considering. For all of my adult life, we have known about greenhouse gases, but it has always been inconvenient or expensive to really grasp the nettle and deal with environmental issues, particularly in commercial real estate. We take the view that ESG and all the bits that hang off that are an imperative, and it's not something that we can or indeed want to ignore. And Ed's going to talk a little bit more about how we deal with the challenges that that ESG agenda, how we deal with those challenges. Diversification is a proxy for risk, and we firmly believe in diversifying our rental cash flows by tenant, by location, by sector, and by property type. And again, we'll see more of that as we go through. Ed's touched on gearing, 25% gearing. A level of gearing, particularly over the long term, when you see capital value growth, enhances returns, but it has also helped us, as we have grown, to minimize cash drag by using largely about 3/4, 2/3 of our debt is long-term fixed rate debt, and the balance is a revolving credit facility, and using that revolving facility to keep our equity fully invested at all times has definitely enhanced dividends and dividend cover over the life of the fund. Why do we focus on smaller properties? And these next two slides are really the center of our strategy. So if you take nothing away from this presentation, please remember this bit. We believe, in fact, we can demonstrate that we can get an enhanced net initial yield on acquisition by buying smaller lot size property. But we also believe that there is no need to sacrifice quality of either property, location, or tenant just because we're buying smaller lot sizes. And I think it's far too easy to assume that smaller lot size properties are for some reason higher risk than larger lots. And again, we'll look at that in a little bit more detail, but I don't hold with that contention at all. As I mentioned before, we want the value of our buildings to be in the bricks and mortar. So when we acquire a property, the very first question we ask is, what happens at the end of the lease? Not during the currency of the lease. We can all see if the property is let for 5 years, we've got 5 years certain income. The big question for us is what happens at the end of the lease. And what we don't want to do is buy properties where we have a binary result at lease expiry. The tenant stays, we get away with it. The tenant leaves, we're in a pickle. What we want is options at the end of our lease, because if the value is still there and we've got opportunities either to enhance the building further through refurbishment or improving the environmental credentials of that building, we can drive rents, let maybe to a better tenant. That's what we're looking for. So always looking for those options at the end of the lease and the value in the underlying asset. Spreading risk, I mean, that's what this game's all about, isn't it? It's about risk and return. And as we're about to discover, I hope, we believe that for taking no additional risk, we can deliver a higher level of income return. And that's what these charts are attempting to show. It's the first time you've seen them, so let me tell you what they are saying. The large chart looks at whole market data back to 2000. It looks at the net initial yield of properties traded in the market with lot sizes of under 10 million in the dark blue line and over 10 million in the light blue line. If you look at the first 10 years, 2000 to 2010, you can see there was a pretty consistent margin. It was about 75 basis points. So let's call that the risk premium. That's the risk premium for buying smaller lots. But from 2010 until today, you can see that that margin has opened up significantly. And there are two reasons why that margin might have opened up. One is that smaller properties relative to larger properties became higher risk, but that just didn't happen. Smaller properties didn't change and larger properties didn't change. The risk profile of those two subsectors of the market didn't alter. What we saw was a change in the supply and demand dynamics in the market. We saw an increasing focus by from 2010 onwards by open-ended property funds, overseas private equity, overseas sovereign wealth funds, all targeting larger lots in a relatively narrow focus on relatively prime large lots, or indeed super prime large lots. That's quite a small supply with huge demand chasing that sector. And you can see how yields have compressed through the period since the global financial crisis. But at the same time, often the very same investors who were pursuing that larger lot size strategy were selling their smaller properties, so increasing the supply of smaller lot size property. And of course, taking demand out of the equation because they weren't acquiring those properties anymore. They used to own them, but they didn't want to own them anymore. So what we're looking at is a demand and supply divergence. And that allows them, if you take the most recent reference point, if you look at the smaller chart on the right, you can see that is tracking the margin. And you can see how that margin really increased in 2010, then started to come in again, but still maintaining a broad 150 basis point margin. And then in the last couple of years through the pandemic, a lot of investors have further pursued that large lot size strategy. And so the margins opened up to 189 basis points today. But we believe that if we take ourselves back to those first 10 years, if 75 basis points is the risk premium, we are at the very least getting a 75 basis point margin for taking no additional risk. But I would actually argue we're not just taking no additional risk, we're taking less risk because we're putting fewer eggs into any one basket when we buy a property. And if we look at real live examples, here are properties all traded last year. They're all in the Midlands. They're all industrial logistics. None of them are brand new. None of them are let for over 10 years. They're all let off similar rents, somewhere between £5, 9 pence a square foot and £5.69 a square foot. The capital value per square foot, you can see huge disparity, 73 and 90 pounds versus 109 and 130 pounds a square foot. And look at the yields. You can see writ large on this page, the very clear yield margin you get for buying the smaller lot sizes. And that would be okay. It would be okay to get that lower yield if you had greater rental growth prospects in the larger properties versus the smaller. But here's the rub. The smaller properties are more expensive to build. So if we are going to increase the supply, if developers are going to break ground and build new buildings, they're going to need to charge higher rents for the smaller buildings because they're more expensive to build. But at the moment, rents are, they're the same, large versus small. So that there needs to be more rental growth to increase the supply of the smaller lot sizes. And if we don't increase supply, then you're going to get supply-demand pressures that drive rental growth. But either way, you're going to see more rental growth out of those smaller lots than the larger lots. And then let's consider risk. Look at that, the asset in the bottom right. It's in Thrapston. It's a fantastic investment. But even in £1 billion fund, that property would be 10% of the fund, 10% of the cash flow. So at lease expiry, the investment manager is going to have a nervous moment. If the tenant stays, that's fine. But if the tenant goes, that's a big vacancy. 10% of the rent roll could walk out of the door in one easy movement. With our strategy, 100 million probably represents 20 properties. So we don't have that cliff edge expiry across our portfolio so much. So I would say we're taking less risk, got more rental growth opportunity, and still we can get 150 basis point yield margin. That feels like mispricing, but it's mispricing that's persisted since 2010. And I can't see anything on the horizon that's going to fundamentally change that dynamic. So we think that our strategy is set fair and we'll continue to be able to deliver a higher level of income return. And Ed touched on this. It's the income return from real estate that delivers 75 to 80% of total return. So it makes complete sense to us to focus our attentions on the income component of the total return. These two charts on the right really talk about diversification. You can see each of the dots represents a property in the fund, and the larger the dot, the more income that we generate from that particular location. But enormously spread across the UK, focusing on the strong regional commercial centres you can see around Birmingham, Manchester, Bristol, and the motorway corridors for logistics, Leeds, Edinburgh and Glasgow up in the central belt. So strong commercial locations, but largely outside the southeast, not exclusively, but largely. And the portfolio has always had a strong focus on industrial and logistics, and that has certainly served us very well in the recent phase of the market. I think in 2021, we saw over 20% net asset value total return from our industrial and logistics sector alone. And strong capital value growth, strong rental growth of nearly 10% in 2021 in industrial and logistics. But we've also seen strong growth in retail warehousing. And you can see as the portfolio has developed over time, how we have decreased our exposure to the high street and in return increased our exposure to out-of-town retail. And that has been much more defensive. There is more value in the land and buildings, and there has been less volatility in rents in out-of-town retail than there has in the high street. And a lot of the out-of-town retailers, the discounters, the food retailers, DIY, homewares, all traded very strongly and consistently through lockdown. So have shown it to be a robust sector in the market. Offices, we think there is life, but you've got to own the right buildings in the right locations and offering the right services to occupiers. And service is a really interesting word, and I use it quite deliberately. Increasingly, as landlords, particularly in the office sector, we need to provide services, not just space, to our tenants. And I might touch on that in a little bit. So what does all of this strategy mean to returns? This chart looks at the NAV total return of Custodian REIT in the dark blue line versus the aggregate of our peer group, so the other diversified real estate investment trusts and property companies in our sector. And you can see that focus on income, while the trajectory of these two lines tracks the market, unsurprisingly. The extra income delivered by Custodian REIT year in, year out does lead to that higher compound return and I think bears out our strategy. And we've done all of this while maintaining the lowest volatility in our share price. So we saw, yes, of course, we saw an impact as the world went into pandemic, and I think our share price fell 25%. And as Ed will expand on a little while, the market oversold commercial real estate, not just Custodian REIT, but I think it oversold commercial real estate. And it should rightly be surprised, given that overselling, quite how resilient real estate has been. And I think we can't lose sight of the fact that the property market is playing catch up, not just from 2 years of pandemic, but prior to that, we had 3 years of Brexit introspection when everyone was frightened of their own shadows. And look, they might well be proved to be right. But I think being the other side of that Brexit decision, people are starting to build confidence in our economy, notwithstanding what might be going on in Ukraine at the moment, which could unsettle markets. So just considering our asset management strategy, we'll keep this simple. We manage the properties in-house. We think that's really important. We collect our own rent, and we think that's really important. And by goodness, it was important when we went into the pandemic. We were able to collect rents through the pandemic by maximizing on all those relationships we had with each and every tenant who we meet at least on an annual basis, and probably speak to more frequently than that. And we managed to collect all the rent that we collected without falling out with a single tenant. And that's really important, because while it is our absolute responsibility to manage this portfolio in the best interests of shareholders, if we don't manage it in the best interests of our tenants, we'd be letting our shareholders down. So we have two very important relationships to manage, both with our tenants and with our shareholders. And the two can't be separated. So keeping close to our tenants, and it's what I call close asset management. A lot of managers talk about active asset management. And active asset management, let's face it, is the minimum you should expect from your investment manager. We should all be actively managing our portfolios. But what we like to refer to is close asset management. We stick close to our tenants. We know our properties well. We know the tenants well. And we are looking all the time, 365 days a year, from that team of 6 surveyors that you saw at the start of the presentation, looking at opportunities to enhance value and maintain cash flow. And those are our two watchwords: enhancing value and maintaining cash flow. Some examples of what we've done recently, and I touched on offices, and the photograph in the top right of this slide is an office building we bought in Manchester, right in the eye of the pandemic, when we believed, despite the fact everyone was working from home and not in their offices, that there would be a return to the office. But in order to attract people back to offices, the offices need to be at least as an attractive place to work as working from home. Otherwise, why would staff bother to turn up? And I also mentioned the word service. And in this building, we are about to embark on a refurbishment program that will try and pick up on what is being called in the property market, the hotelization of offices, providing a level of almost concierge service to office occupiers, and giving them both flexibility and service that a typical 25-year lease, when you have to fit the building out yourself, deal with dilapidations at the end, we want to take all of that away. And in return for that, we are being advised and firmly believe that we will both minimize vacancy and drive rents on. And of course, that's absolutely what we're about. So we do think there are opportunities in offices. We also believe that we have no family silver in this portfolio. If it's the right time to trade a property, we will trade it. We are not out and out traders. We believe in holding assets for the long term. And much as you would with your own house, enhancing and refurbishing those assets to keep them current and to maintain the value over the life of those properties. But there will be times that it makes sense to take profit. And we sold last year and also invested buying Drum Income Plus REIT in the autumn of last year for £21 million, which was at a 21% discount to net asset value. In the first quarterly NAV statement post-acquisition, that acquisition alone has shown us a £7 million increase in net asset value. So a strategy that their strategy is very similar to ours, smaller regional properties, strong income focus. It was a very good fit, and we think has been a good deal for our shareholders. We did sell last year, took £4.2 million of profit on the sale of 10 properties, and as Ed said, we are in the process of redeploying those proceeds, which will build us back towards our 25% gearing target. Just an example of the opportunities that come from having 160 properties spread across the UK. It means that every year we have 30 to 50 lease events, and each of those lease events gives an opportunity in a rising market to push rents on. And the building in Redditch, which is the 4th building down, or 4th photograph down, that building we relet, rental increase of 10% on the previous passing rent, and a 24% increase in valuation. Now you multiply that across 160 properties and something happening almost every day, you can start to see how we're managing this portfolio. And at every opportunity that we have, we will try and enhance the environmental credentials of the building. So the final photograph you can see there, this is a building in West Bromwich. We've done a full refurbishment of that building. We've taken out all gas supplies, so it now has air source heat pumps, electric air source heat pumps heating the offices. We got a PV solar array on the roof, so we're generating electricity which we sell back to the tenant. We put in EV charging points, and all of that has improved the energy performance certificate, the EPC, from a C to a B, and seen a net valuation increase of 47%. So don't let it be said, and don't misunderstand, that the challenge of meeting our environmental credentials is just a cost to shareholders. We think there's a real opportunity to drive value by the careful deployment of investment into the right areas to improve the quality of buildings while also driving value. Ed, as I said, we're just going to demonstrate quite how resilient real estate has been through the pandemic.
Thanks. Yeah, this slide shows the year to March 2021, so the sort of first year of lockdown. And so in the context of a 25% fall in Custodian REIT's share price at its lowest point, you can see on the screen that like-for-like valuations were only down 2.5%, passing rents only down 5%, occupancy only down 4.5%. Interestingly, estimated rental value actually increased over the course of the first year of the pandemic because of the strength of the industrial and logistics market during that time. Rent collection remained robust and above 90% for the year, which I think, if we think back to April 2020, wouldn't have been sort of within our forecast at that point. We only had to concede a very small amount of the rent rolling concessions. We did see some administrations and CVAs losing just over 3% of the rent roll. But again, really importantly, we were able to maintain a good dividend yield across that period. At the onset of the pandemic, we cut our dividend by about 50%, but have gradually been able to ramp that back up, doing regular increases and even paying a special dividend in June to get the dividend back up to a suitable level. And we fully comply with all of our banking covenants throughout the pandemic as well.
So I think as Ed demonstrated, none of the numbers on that slide look like a 25% movement in share price. And happily, a lot of that has been clawed back. But I think given where we were at the start of the pandemic, it will be a surprise probably to most investors quite how resilient the real estate market has been. And I think a large part of that is at the point I touched on earlier, that we are playing catch up. So on to the next slide. And Ed, back to you to talk through our ESG strategy.
Thanks. I mean, over the last few years, we've really embedded ESG targets into our property strategy, and you can see the KPIs shown on the screen, and ESG really is now an imperative for real estate. At the top, you can see our commitments to reduce emissions by 30% and energy consumption by 15%, and that's requiring significant tenant engagement. We've implemented an online platform called Adapt to collate tenant data and interrogate it to help identify areas for improvement, with an aspiration to fully automate that data collection process. And we're underway with a rollout of smart meters to help facilitate that. I'll talk a bit more about EPCs on the next slide. We're only choosing energy suppliers who offer 100% renewable tariffs, and we're investing heavily in on-site renewables and electric vehicle charging. You can see on the right-hand side of the slide, there's a picture of an InstaVolt charger. And a couple of years ago, we put 16 of these chargers across a number of our retail warehouse sites, all on 15-year leases, giving us a reasonable annual return. Interestingly, even in the couple of years since then, the model has really moved on. And so we're now engaging with a business called PodPoint to roll out more EV chargers across 6 more of our retail warehouse sites, and starting to look at some offices as well for exclusive tenant use. But the PodPoint model is with us paying for the kit and then taking the lion's share of profit of effectively selling the electricity. And we're looking at a payback period of only 4 to 5 years on those charges based on current projections. Where possible, we're incorporating sustainability or green clauses into leases, which typically oblige tenants to share data, allow us to install carbon reducing technology, and generally input other energy efficiency measures while the tenant's in situ. And as well as setting targets, we've also committed to being compliant with all ESG legislation and following best practice. So we've opened ourselves up to scrutiny by committing to EPRA and GRESB benchmarking, and have also started to report under selected elements of TCFD to assist with our environmental governance and risk management processes. On to the next slide. This shows the EPC ratings of the portfolio and how they've moved on from March 20 to March 21. So during the course of that period, we re-rated nearly 1 million square feet of floor space. That's probably nearly a third of the portfolio, and carried out 63 EPC assessments to show the aggregate improvement you can see from the bars. And importantly, you can see the G and F ratings have all been improved, so shifting to the right on the chart. And so at the moment, we're sitting with an average, weighted average of a very high C across the portfolio. And onto the next slide. This is the actions speak louder than words slide. So Richard's already talked briefly about an asset in West Bromwich, but this slide has a couple of other properties where we've refurbished, but with a very keen eye on improving their environmental credentials. And I should reiterate that these improvements not only meet our ESG targets, but also significantly added to valuation. So this slide shows some before and after shots. So at the top is an industrial building in Warrington, where we replaced the roof, built new offices, relayed the yard with new roller shutter doors, and you can see from a letting increase of rent of 23%, with a significant improvement in EPC from an E to a B. And at the bottom, we replaced this rather tired looking trade counter unit, formerly let to HSS Hire, with a brand new Starbucks drive-through, improving the overall tone of the park, increasing rent on a long lease, and improving the EPC rating from a D to a B. I'll hand back to Richard.
So just before we open up to some questions, a forward look, where do we see Custodian REIT? I think we are absolutely committed to our regional diversified portfolio. We believe in maintaining that weighting to industrial logistics and think that there is a lot of latent growth still in our existing portfolio, and we are actively buying in that sector at the moment as well. Retail warehousing, particularly those let off low rents and those that are in the discounting food, DIY, homewares sectors, we've seen strong growth in the market over the last 12 months. But again, we still see that as reasonably defensive and with room for rental growth. Selective offices, and I've touched on that, so I won't go through that again, and drive-throughs, where we are both acquiring these and developing these on our existing portfolio. And Ed gave an example of one, which is in Burton-on-Trent. And there is a mismatch of supply and demand. There are a lot of operators trying to get into that drive-through market, and not a very sizable portfolio of existing drive-through assets in the UK. So I think we will see more of that, but there's some good rental growth opportunities. And throughout everything we do, keeping a keen eye on our ESG goals as we develop. And as for the sectors, it would be easy to say that industrial and logistics have had a very good run. And I think that's right. And I think that yields are perhaps topping out. We're probably getting towards the top of a cycle, but yet that we still see a lot of latent rental growth in our portfolio, and that is still to come out. So we don't think that the party is quite over yet in that sector. Retail warehouse rents, as I said, they were falling through last year, but pretty much feel like they bottomed out in Q4 of 2021, and we see that there's a good place for a recovery, because they are at long-term average low levels compared to where they have been. And we might even start looking at the high street again. That we saw for the first time in 4 years in Q4 of 2021, high street retail values tick up and high street retail rents start to show some recovery. Now, it's been a tough market, but this is one of the benefits of being a diversified fund. We can take opportunities to move into different sectors when they're at the start of a cycle, rather than just being forced to keep going in a single sector. And a final thought from me, and I will read my own quote: in an increasingly theme-led investment world, don't overlook the benefits of diversifying risk and targeting sustainable income from well-let real estate. And we believe that that's what Custodian REIT can deliver. Any questions?
Brilliant. Thank you so much, Richard and Ed. We've got quite a few questions. First one is a combination. In an earlier slide, you measured the trust NAV returns versus your peer group. Can you confirm how you defined that peer group? And also, could you explain the reason for the trust discounts versus the peer group and also its own average over time?
Yeah, well, let's go back to that slide. So here you can see at the bottom of this slide who we define as our peer group. So we've got AEW, AEW's REIT, AWU, these are all their tickers. BMO's Property Trust, BMO Real Estate, Drum Income Plus REIT, of course, who we consolidated into Custodian REIT, but they form part of the peer group over that period. Epic, which is Eddiston, Picton, REI, so real estate investors, Regional REIT, Schroders REIT, Standard Life Property Investment Trust, and UK Commercial. These are all regional diversified funds, and so that's how we've defined the peer group. The second part of the question, I think, was around the discount. We have typically been if not the highest, the second highest rated relative to NAV of our peer group. How have we maintained that higher rating? I think one of the reasons has been our absolute focus on income and paying a higher dividend. So if we are paying a dividend of 5.5p and one of our peers with a very, very similar strategy is paying a dividend of 5p, the market might smooth out that difference, which would then put us at a higher rating than our peer group. So I think a strong focus on income and the low volatility of our underlying assets gives an awful lot of our investors confidence, and that has helped with the rating. And I think the other thing to note is the makeup of our shareholder register. Our shareholder register has a very large number of private clients, small private client wealth managers who have invested for the long term. So they are not looking at our relative premium or discount on a weekly, monthly, quarterly, or perhaps even annual basis and thinking this is a time to get out, or should I be increasing my holding? They've bought for the long term, they've bought for income, and the income keeps coming, and that has, I think, reduced volatility and kept us closer to our sort of our NAV pricing.
Thank you. This is a question on inflation and rental income growth. How much is property really a hedge against inflation?
Yeah, and that's such a pertinent question. The first thing I would say is that make an absolute statement, why not? Property is a good hedge against inflation, but it does not necessarily run to the same time schedule as inflation. So if we see inflation over the next 12 months, don't hold me to the fact that Custodian REIT will keep up over that 12-month period. But if you look at it over a 5-year period, then absolutely real estate will catch up. And it catches up because of rental growth. We have the opportunity in our portfolio, as I said, with 160 properties and over 250 tenants, to increase the rent review and lease renewal in line with market conditions. And in inflationary times, rents should rise to keep pace. Otherwise, they're falling in real terms. And if we look across our portfolio, at Q4 last year, we saw 2.6% rental growth in industrial and logistics, and nearly 10%, as I mentioned earlier, over the whole year. So you might say, well, we've had all the rental growth that we're going to see. But of course, we haven't had a rent review with every property in our industrial and logistics portfolio yet. So there's a lot of latent growth sitting in the portfolio. The average passing rent across our logistics assets is £5.27 a square foot. And our valuers give an estimated rental value across that same portfolio of £6.20 a square foot. So there's nearly, there's an 18% latent rental growth sitting in the value of those assets that's yet to come out. But here's another interesting thing about that. Even at £6.20 a square foot, which is the valuer's expectation of where rents might get to at next rent review, you couldn't bring forward new development. You're not going to add to the supply of smaller lot size property with rents of only £6.20 a square foot. It's not enough to bring forward new development. So there needs to be more rental growth if we're going to see an increase in the supply, which is then going to take the pressure off rental growth. We've got to see higher rents yet before we start to see an increase in supply. So we think that that's our view of rental growth today. But it could take up to 5 years to see that rental growth drop in, because we might not have a rent review for 5 years. Retail warehouse rents bottomed out. High street retail rents started to climb in the fourth quarter of last year, and they're both growing from a very low base. We've seen quite a bit of pain in rents over the last 4 years in the retail sector, but they've got the opportunity to grow from a low base. And of course, retail of all the sectors is the one that best keeps pace with inflation and the retail prices index. And in offices, there's going to be a two-tier market. For the right assets, we will absolutely see rental growth. And where you offer that higher level of service, you could see up to 25% increase in rents over current market levels. and market levels which have been held back for up to 5 years. So we're really seeing catch up in that sector. So those rents, I think, will help it keep pace, but don't please hold me to that over 12 months. It's going to take 5 years to play out, but over that time period, yeah, it should be a good hedge.
Brilliant, thank you. There's just a few questions on the hotelisation of offices.
Yeah.
What are tenants looking for in this hybrid world? What additional margins you get through the hotelisation of office market, and what does the hotelisation service cost?
Yeah. The answer is we are not quite breaking new ground, but we're certainly at the vanguard of other landlords in providing this. So it's still to be proven. But from all the conversations that we have with occupiers, and being an occupier ourselves, part of our wider business, we've got offices across the UK, we know that there is nothing tenants hate more than looking for office space and finding floor after floor of empty buildings with grey carpets that they can take a lease on for 5 years, so they've got to fit it out themselves, they've got to get an internet connection in, none of which they have experience in doing, none of which they have interest in doing, or the time to, or resource in their business to give to fitting out offices. And worse than that, the bit they really hate is at the end of the lease, having to pay dilapidations to the landlord to give the building back in the condition it was when it was taken on. And furthermore, what we're then asking tenants to do is to take a building, fit it out, and 5 years later, strip all the fit out and put it in the skip. That's not very good for ESG credentials. So what we are convinced, and we've taken advice on this, we're not going it alone, that occupiers want is space that they can walk straight into. And let's face it, most people need the same thing out of an office. They need, if you've got an office of 30 plus people, you need a large meeting room, a small meeting room, good breakout areas, kitchen facilities, a comfortable reception area, and desks and computers. And mostly it's all wireless. A lot of people are using laptops. There will be an element of hot desking in there, almost certainly. And we're seeing that expectation is that flexible working is going to be the watchword, but certainly 3 days a week, these offices are going to be pretty heavily used. So this is what we're trying to provide, turnkey offices that occupiers can walk into and probably pay an internal service charge to pay additional rent in lieu of the fit out and dilapidations at the end. So we as the landlord will own the fit out of those offices and won't be putting it a skip every 5 years. And that means we can put in slightly higher quality fit out because we know it's going to last. And almost certainly, if we give tenants the flexibility that they demand, they'll never use it because they'll realize they can't get that same quality of service and space elsewhere. So that's the concept behind it. And we've got to make these offices nicer than being at home. So within the redevelopment of the building in Manchester, we're also converting the former plant room, which is up on the top floor of the building, into a covered roof terrace. It's in Manchester, so it needs to be covered because it can be a bit damp in Manchester. A coffee lounge, additional meeting rooms, all for the use of the tenants in the building. There's even going to be a yoga studio, which will be a multifunctional space, but amongst other things, it could be used for exercise classes, yoga or whatever. And these are services that you will not get in a standard office letting, but enormously attractive to occupiers. And most occupiers say, we're happy to pay a bit more if we can take all the hassle away. And if you look across all markets, this is just consumer behavior. People don't buy their own cars anymore. They lease them and they get a new one every 3 years and they get a service plan and all the problems are taken away. They don't own their own telephones. They lease those, and when their battery is getting a bit shaky, they get a new telephone. People are demanding a higher level of service but don't necessarily want the same level of responsibility and ownership that perhaps consumers of 20 years ago. So that's the strategy.
Brilliant, thank you so much. How is the structure of your debt going to be impacted by potential rate rises? And what are the wider implications for the property sector?
I mean, at the moment, we've got 61% of our available borrowing facilities are at a fixed rate of interest, or 86% of drawn facilities are at a fixed rate. So I think Richard mentioned earlier that inflation, there would be a lag with inflationary pressures impacting rent. I mean, I think similarly, we've built in protection so that there'll be a lag if that inflationary pressure results in interest rate rises, which is looking likely. There'll be a lag between those rises and it significantly impacting the dividend capacity of the fund.
Brilliant, thank you. Could you go into further detail about tenancy rollover risk within the portfolio? What impact did lockdown have on these? And what is your outlook in terms of tenancy agreements?
Well, picking up the lockdown point, and I think Ed talked to this in one of his slides, we did see an increase in vacancy through lockdown of about 4.5%. And some of that was tenants failing, and some of that was tenants putting their businesses through company voluntary arrangements, which we weren't prepared to accept. So we took back possession of those buildings. And in, I think, every case where we've taken those buildings back, we have already re-let them. We don't want tenants that don't respect the landlord and tenant relationship. And we believe that company voluntary arrangements, CVAs, are specifically designed to disrespect that relationship. And we are not prepared to put up with that. So some of the increase in vacancy was at our own hand, standing by our principles, and we don't regret doing that. The rollover of tenants more generally, and this is one of the great things, we've got 250 tenants. So, tenant lease expiries and tenant breaks are part of our everyday life. And no one building let to any one tenant represents more than 2% of the rent roll. So there is no one property out there that can really damage the cash flow of the portfolio as a whole. So the rollover of tenants, I would say, is not so much rollover risk as rollover opportunity, because it's only when we get the properties back or when we get the opportunity to discuss new lettings with tenants that we get the opportunity to invest in the buildings, keep them current, keep them up to date with modern environmental standards, drive forward rents, build in the flexibility that tenants want in return for a higher level of rent. So I'd say we see it as two things. Firstly, it's just business as usual. It's what we expect and what everyone should expect. Leases get shorter every day. No one can hide from that. We can't stop the passage of time. So much better to embrace it, acknowledge that this is an opportunity, not a risk. And this is why we have an in-house management team of 6 surveyors working flat out to maximise the opportunities that rollover of tenants creates.
Brilliant, thank you. How much is ESG actually going to cost in terms of CapEx? And are there any disadvantages to shareholders from the upgrading of your properties?
My favourite topic, ESG. I think, I mean, we've seen some other funds come out and say that they're expecting X% of NAV to be taken on sort of ESG related CapEx, but I think we treat expenditure on improving buildings' environmental credentials as just necessary investment to ensure they remain in demand from occupiers and that rental levels are either at least maintained, or as Richard talked about, there is opportunity there for that expenditure to grow rents. So I think thus far, the work that we've done, the significant refurbishment work we've done, has led to significant valuation increases on the back of that expenditure. And I always expect to see some positive valuation impact of that work coming through, certainly at least in the medium term, if not immediately. So I don't really see a disadvantage to shareholders, because ESG expenditure is really an investment in future-proofing assets and increasing rent, and giving us an opportunity to acquire poor performing assets and improve them. Potentially buying poor performing assets from landlords who don't have the capital backing to invest properly in those assets. So I think we see it as a positive for shareholders, and probably an opportunity as well.
Thank you. Could you elaborate more on geographic diversification, specifically reasons to be ex-London, Southeast, and also out of town?
Look, diversification is at the centre of our strategy, and as I touched on, diversification is a proxy for risk reduction. So we firmly believe in diversifying, and we are not opposed to buying in London and the sort of close southeast, but our experience is that there is inevitably more competition in London and the southeast, and that means that our entry price is higher than we would ideally like to pay. But we also acknowledge that the dynamics that are driving demand in London and the southeast, which is population growth and supply and demand imbalance of real estate, those same investment credentials are valid in lots of different micro markets across the UK, where there is less investment competition, and we can buy and secure that initial margin that helps drive long-term performance and maintain that higher income return that we like to pursue. So I think it's about being broad-minded about the market as a whole, and understanding what is actually driving growth, rather than just having a blanket, it's London and the southeast.
Thank you. And just another one on diversification question. I see the number of properties in the portfolio is substantially larger than some of your peers. Are there trade-offs between rent roll risk and managing such a large number, or is it quite manageable? And do you have a cap on total number of properties that you can manage?
We don't have a cap. I think there's a misconception here. And the misconception is that managing properties is the challenge. The challenge is managing tenancies. It's the people in the buildings that cause all the problems, not the buildings themselves. And if you were to compare the number of tenancies that we have with our peer group, you'll find that we are mid-table. Managing, and it goes one stage further than that. Most of our properties are single let, so they're let on what's called a full repairing and insuring lease, which means the responsibility for managing the property, looking after it, maintaining it, repairing it, sit entirely with the tenant, and it's our responsibility to hold the tenant to the terms of the lease. With a multi-let property, you lease just the space you occupy, and all the common parts are managed by the landlord. So with a multi-let property, you may have a single property, but it might have 20 tenants. We would have to spend a lot of our time working for the tenants, managing the communal spaces and keeping the external envelope of the building in repair. And that's an awful lot of management time working for the tenants, when we really want to be working for shareholders in driving value. Now, the tenants pay for that through a service charge, but it nevertheless an awful lot of time. So managing a portfolio of single let assets is much less time intensive than managing multi-let assets. So the number of tenants and whether they're multi-let or single let is actually what you need to look at to answer the question of whether we are stretched. And the final point to touch on is, if it is more expensive in time and effort managing a larger number of smaller properties, that expense sits with us as the investment manager, not with shareholders. Our investment management fees don't change as a result of having more properties. In fact, as the portfolio grows, those investment management fees come down. So if the fund gets larger, It will actually reduce costs to shareholders, not increase them.
Thank you. Can you explain and give an example on what you mean by greater share of value in bricks and mortar?
Yeah. I mean, I touched on this as we were going through, but let's just consider a live example. This is a property we're buying at the moment. It's an industrial building. It's in the Midlands, and it's just been valued at 2.1 million, and we're buying it for 1.8. It's let for 7 years. It's 15 years old. But if it was vacant today, the value of that building would be 1.8 million. So we're buying it with 7 years income for the vacant possession value. If we were buying an office building in a similar location, let on a 20-year lease, all the value would be in that lease. And that value would slowly decline over time. And as you got into the last 5 years of the lease, decline very quickly towards the vacant possession value, because in that scenario, probably 50% of the value would be in the lease and 50% of the value would be in the bricks and mortar and the land. So that's a less attractive investment for us because it's over the long term a depreciating asset. Whereas with the example of the industrial building we're buying at the moment, it's not depreciating it at all because the vacant value is the same as the investment value. A valuation is made up of three factors. We've got the land that the building is built on. And you should expect that land appreciates over time. You know, it's been a hackneyed old phrase, but they ain't making it anymore. You've only got what you've got. The building will depreciate over time, but it might depreciate over 25 years. The lease depreciates over the term of the lease. So it's the fastest depreciating part of that value pyramid. So we want all our value to be in the bit that depreciates most slowly, or better still, appreciates. So if you've got value in the land, the next slug of value in the building, and as little value as possible in that lease, that's what we're looking for. Not always easy to identify those opportunities, but that's how we go about it.
Thank you. With your focus on distributing income, could you remind us again how much dividend cover the trust has and what's your outlook for the dividend cover?
Ed, do you want to go there?
Yeah, I mean, cover was 105% for the 12 months to end of December. I think, I mean, it's an absolute key focus of my team to forecast forward what that cover is going to look like, because ultimately that's a key driver of where the dividend strategy will take us. So yeah, in terms of outlook, yeah, the outlook is absolutely a fully covered dividend, so more than 100% of earnings cover, but we will try and balance it where possible to keep that cover just over 100 to make sure we're maximizing payout. Bear in mind, we have to take into account, you know, expectations on acquisitions and disposals, you know, so we understand, you know, where the capacity goes, where the earnings level goes, and if we're intending to issue new shares or everything else. So I mean, I'm not going to sit here and just give you a number, but it's going to be in the low hundreds going forward.
Thank you. And just final question on the shareholder register. Who are the largest shareholders? And there's a question about director holdings, but also investment management team holdings.
I mean, the annual report sets out the substantial shareholders. So I think off the top of my head, no one's got more than 6% of the register. The larger holders are typically investment indices, so just tracking REITs. Yeah, the parent company, the investment manager, Mattioli Woods, is shown on there at about 5%. I think, again, directors' holdings are shown in the annual report. Majority of directors have got a small holding, and Ian Mattioli, who sits on the board as a non-independent director, I think his family in the round have about 1% of the register.
Yeah, it was also worth noting that the advised clients of Mattioli Woods are collectively substantial shareholders, but they are all individually advised and act independently of each other. So they make up 60-odd% of the shareholder register, with a substantial and growing core of platform and smaller wealth management clients who are particularly attracted by there's a long-term secure income.
Brilliant, thank you. That comes to the end of our presentation and questions. So thank you so much, Ed and Richard, for your very insightful presentation, and also for everyone who's been listening. So thank you so much. If you have any further questions, please email distribution@frostro.com. Otherwise, we will end the call here. Thank you so much, everyone.
Thanks.
Thanks all.